on the line. I don't know if they're going to be talking. Cheryl, I'm hoping that you're going to make this talk more exciting than the Springbok French game. So if you even get halfway to that, it would be great. And so Cheryl, you need no introduction. Everybody knows you as the expert on trusts, etc., and estate planning. So Cheryl, without further ado, the floor is yours.
Thank you, Stan. Afternoon, everybody. It's really good to be back up and working after an almost 2-year sabbatical. How do I, now my next one is my slides. If you can, is it do I just go onto the share screen? Danny, you're on mute.
All the things are ringing. I had everything muted. Let's see if you share, if it still lets you share from the browser.
Yeah, let me try then on that side. Give me 1 sec, folks. Is this, are we on? And share. Can you see the slides? Danny, you're on mute again.
You might have to change what you're sharing because you shared. Okay, there we go. Now we better.
Is that it?
But it's the presentation. I don't know if that's not the proper screen view.
So I'm sharing at the moment from, so hold on. I think, let me swap. Sure, I'm stuck. I'm not sure how else to change the slides.
Let's see, viewing option. Access to the screen.
Can you see anything of the slides at the moment?
We can see this. The current slide. It shows the slide, and then the next slide. It should actually. This is your presentation system. Everyone's phoning me now because of the issues. Hold on. Hi, Danny speaking.
Okay.
All right. Sorry about that.
Taking off my other screen. How does it work?
That works better.
Okay. So can we start and can we go from this? Yeah, I'm hoping, and I can't see you. I'm not sure from the screen point of view. All I've got is the big slides in front of me. I want to say from a trust point of view, a lot has happened this year with regards to trust, the UBO, the grey listing. I want to say we had all those bad words a while back in the form of KYC and AML. I think UBO has joined that list at this stage. For me, I think it's been really positive for probably 2 reasons. One, internally within the practice, it's allowed us to sit down and have a careful look at the cost benefit for clients, especially those clients on a borderline basis of should we or shouldn't we keep the trust. With the increased compliance requirements and information and the cost of actually administering trust now at the moment, it's been a good exercise to have a look and see, are there trusts that we could consolidate or wind down, or again, just review the purpose of having trusts. I think from an industry perspective, I know I've been fairly vocal over the last 20 odd years on the basis that as an industry, we're one of the only countries, or one of the few countries where you can kind of have mum, pop and an accountant or attorney or a family friend as a trustee without the system having been regulated and formalized. I think now with the UBO and the master requiring information, it certainly has shaken up the fiduciary industry. And if you hold on for the interval in another half an hour or so, I think the South African industry is due for one more shake-up as far as trusts and financial planning is concerned. But having said that, is there a place for trusts in any estate planning, both locally and abroad? The answer is definitely yes. It just needs to be at the right cost and for the right reason. So with the course outline today, we're going to have a look at what has happened locally with trusts and then the foreign landscape. So are trusts still a viable planning structure, again, locally and offshore? And then a major new welcome for worldwide estate planning. This is hot off the press. And then I've brought in previously capitalizing foreign trusts and the structure set up, because the changes have essentially only coming now from the beginning of August. And I think there's quite a bit of planning. One can't do a knee-jerk reaction with regards to the worldwide side. And we need to have a look and see what have we been doing, what has been done, and whether it's actually worth merging and doing a crossover as such. And then lastly, looking at wills, the South African and offshore wills. So what's happened locally in the trust? I am going to touch on the UBO and just the information, because I think it's quite important that as practitioners, we understand the landscape that we're dealing with, especially as far as the regulatory requirements are concerned. And then also our responsibility as tax practitioners, both to the clients, both to the regulatory bodies. And then I want to say to ourselves, on the basis of, are we providing best practice, best service, given, or best advice rather, best practice, best advice, given I will use the word, the onerous responsibility, A, of being a trustee, and B, the huge increase in regulatory information. So if we have a look, there was amendments recently to the Trust Property Control Act. We had the UBO reporting to the Master's Office. As trust and company service providers, there's a registration with the FIC, Financial Intelligence Center. We've now got SARS reporting, and the changes in the detailed beneficiary information. We've got massive reporting due for May next year. And then I've also brought in a case study with regards to a majority of trustees' decisions. So having a look at the amendments to the Trust Property Control Act, it's long overdue. I don't think they've brought in what should have been done as far as the Trust Property Control Act was concerned. For instance, to give you an example, it says trustees need to keep financial records. For years, there's been wearing a hat on as an accountant. There's no format is such with regards to the set of financials. I know in practice, often we use the financials for SMEs, but information is required with regards to trust capital, understanding the difference between initial capital or pure capital, as far as capital gains are concerned as such, and then income and what one needs to report from that perspective. So I will say I was hoping that with the Trust Property Control Act, we would have had more information with regards to the administration. A lot of what was changed as a result of the Amendment Act, which was aimed at combating money laundering, terrorism, and other financial crime. And I know certainly from a SARS perspective, they've always had the stance that trusts are used to avoid tax as such. And I know from a money laundering point of view, trusts have always been seen as the vehicle through which individuals have hidden financial assets as such. And I see yesterday in Maverick, there was another comment made in connection with the South African with regards to the use of trusts. So trusts have I want to say the ugly stepsister from that perspective. And on a worldwide basis, we've got this intense focus on who's actually behind the trusts and what are they being used for. A quick summary of the main. Yes.
There's a question asking, what does UBO stand for?
Oh, sorry, also, ultimate beneficial owner. How do I get... Sorry, I'm not sure if you've got the security. I don't know if I can make my screen smaller. without losing, because I can't see anything other than just the slides. So if you can help me with, I don't want to go back into, no, the double screen's not going to work. Sorry, if there's, Danny, could you help me then with the questions?
I'll monitor the questions. There's just another little box you might just, if you can click to hide.
Oh, shit. So if I can click to in show screen. Oh, sorry, folks. No, I'm battling here then on the basis of
let's go back to
now the screen's gone entirely. Are you back there with the screen? With the
yeah,
with
now
the
it's
slides?
perfect.
All right. So, folks. So, in connection with the summary of the Trust Property Control Act amendments, they've aligned to some extent the disqualifications of an individual from being a trustee in line with the Companies Act. So, in other words, somebody who's been insolvent or guilty of offence. It clarifies that non-resident trustees can only act once the master's appointed the person. In other words, the issuing of the letters of authority. I want to say from a South African perspective, that's not really a change, and it's applicable to resident trustees as well. So I've had a couple of questions over the last couple of months, especially with the delays that we've been having at the Master's office with regards to the letters of authority, where people have actually wanted to sign off as trustee or for trustee to be registered or still pending appointment. The answer is no. You cannot act as a trustee in any capacity or legal capacity as a trustee. You might wear it with your hat on, maybe for instance, as the financial advisor, or with your hat on as the attorney, the tax practitioner, or the accountant, but in your capacity to exercise discretion and be party to any decision-making process, you cannot do that until such time as the letters of authority are issued. And yes, with the delays that we've had at the master, it has actually held up a number of transactions or a number of or activity then as such. The master has also been given additional powers to remove trustees from office. And then when in acting as a capacity as a trustee, now in terms of the new Trust Property Control Act, but that's also got to do with the tax amendments, is that you've actually got to give full disclosure to any accountable institution. An accountable institution includes an estate agent, banks, and attorneys. In a recent example, a client was dealing with an estate agent with regards to the sale of property, and the estate agent was continuing on the basis of the property was in the individual's name, only to later find out it was actually held by the trust. So it's important when you deal, you need to understand which hat you're juggling, and you might be the beneficiary of the trust. It doesn't mean that individuals then got any authoritative powers in dealing with any trustee matters. Other amendments.
Before you start the next point, there's a question regarding the registration with the FIC for TCSP.
Okay, I'm going to deal with that. That's in a slide coming up here now at the moment as to what one needs to do with the registration. So just going down then, the trustees also have to keep record in a prescribed format, details of accountable institutions who are acting in an agency capacity on behalf of the trust. So for instance, any accountant, legal or attorney has to, if they're acting as a service provider, or if you're in your capacity, and our practice is very much like that, where we don't necessarily take on trusteeship as such, but we provide the trust secretarial services. We're an accountable institution as an accountant, and B as trust and company service provider, and therefore the trustees need to acknowledge that we are performing the secretarial function, and more importantly, they need to actually give that authority to act in the capacity as such. My recommendation is that a trustee's resolution should be prepared, signed by all trustees. And the reason I'm saying all trustees is that it's quite onerous with regards to providing the UBO, the ultimate beneficial ownership information, because that information is put out to SARS, it's put out to the master's office. As practitioners, we need to do KYC, know your client, and a due diligence in terms of our if I see the Financial Intelligence Center reporting. So that information is out there, and given the misuse of information, my advice is, as a professional person, make sure that you've got that authority. You know in what capacity you're acting as such on behalf of the trust, whether it's in an agency capacity or wearing your hat on, as I say, as an attorney, an accountant, practitioner, tax practitioner, or trustee. And if it's outsourced to you, again, just understand what your parameters and the scope of assignment are. And then the last amendment was, or not the last, but one of the amendments then in connection with the disclosure of ultimate beneficial ownership. What's important is that trustees need to keep certified copies of all official identification of each of the ultimate beneficial owners. I wasn't going to go into a huge amount of detail as to who and what is a UBO as such, but just to clarify in case there's any questions, ultimate beneficial owners are basically your founder or settler of the trust, donor, all of your trustees. Now there's again it's not clear, and there seems to be some controversy whether it's previous trustees or it's the current trustees. From our stance, our view is it's the current trustees going forward. From a beneficiary perspective, it's all named beneficiaries. And again, in some instances, it's beneficiaries, or the view is it's people who have received benefit from the trust. And it's anybody who exercises excessive control or control over trust assets or over the administration. So again, let me give you an example. If you as an accounting firm draft the minutes on behalf of the trustees, but you're not a trustee in terms of the letters of authority, but you might have a bank account as such, then to that extent, my view is that beneficial ownership information should be provided in this case because of when I say the control in the form of managing the accounts, operating the bank account, etc. So again, the definition for UBO is quite wide. I certainly don't want to be, I was at a small practitioners meeting the other day, and somebody said, well, they're just going to put everybody and sundry down and make sure that all bases are covered, especially given the very last line where at the end of the day, failure to comply is punishable with 5 years imprisonment or a 10 million rand fine. I think that's A, overkill, and B, we've got to actually be clear on the information that's been requested. And as an industry, I think we need to uphold and maintain good standards with regards to reporting. So it's got to be a balance between somewhere on the basis of I'm giving the minimum in the form of settlor trustees and named beneficiaries and not worrying about anybody who's received past benefits or control versus somebody that if there's been any action with regards to the trust, we'll then disclose that information.
Before you carry on, next, got two questions. It's more can a service provider be a private person and not a registered accountable institution? And can the accountable institution and the trustee be the same person?
Okay, and the answer to that is yes to both. With regards to the accountable institution and the trust company service provider, it does actually say that as soon as you provide the services for benefit of in a commercial on a commercial basis, then yes, you need to be registered as an accountable institution. So the question is, if, let's say, for instance, you've got your best friend as it's you, your wife, and a best friend as the trustees, and the best friend's in there as his capacity as a friend, he's not necessarily an attorney or a profession then as such, somebody amongst the three of those trustees need to be registered with an accountable institution as such from a FIC perspective. So to that extent, you'll find that's where there's the outsourcing to third-party agents to attend to the information, but the answer is no. Neither the Mr., Mrs. and or the friend need to be registered with the FIC if they are not providing, if they're not seen as a trust company service provider in the form of an economic sense and a benefit. But yes, you can have an accountable institution also being a trustee. Just in connection with the UBO reporting then to the Master's Office, and in fact, I'm not, let me go through the slides rather on the basis. It's in a prescribed Excel format. That format is available on the Master portal. And once the information is submitted, there's a URL link that comes out to say, thank you for filing, here's what's been received. And below that, if you click on it, says, we received the information in connection with the settle, the beneficiary, the following person has submitted the information, this is that person's email address, this is that person's cell phone number. And in fact, when you click onto the portal initially, it says, and you've seen at the start of this, I'm technologically challenged, and I don't understand the, is it an IPL or whatever the addresses are, but from a master's perspective, they actually link your server or your domain back to or the computer or whatever that IP address is, so they can actually follow and see where that information has eventually come in. I understand it's a blueprint or security print. You'll see I've used the words there, CYA as an administrative trustee or an agent, CYA being cover yourself, in that as a professional or acting in an agency capacity, make sure that at the end of the day, you've got a trustees resolution in place approving the reporting and holding of the information. And we've actually gone a step further where we've asked for the beneficiary's consent as well, just given the Puppy Act and given the fact that that information, and when I say that information, it's pasted in a master's portal, it's pasted on SARS as such. From a FIC reporting point of view, you only need to report anything if you believe that there's a transgression as such. So you're not giving the FIC any information, but when you do the worldwide checks and the due diligence as such, that information is put out into a public domain. So just wearing your hat on as a trustee or the administrative trustee or an agent, just make sure that whoever's information you're dealing with, you have their consent or they're aware of the fact that you're dealing with information. Registration then with FIC for trust company service provider.
There's two questions, sorry, before you start the next slide.
Yeah.
Is it specific date for reporting all these informations to the master?
It was the 31st, I think it was the 31st of May. I know we're working towards the end of October, which we're not getting to, but so from a reporting date, there actually isn't an official master's office date. My advice would be certainly to get it done before the next financial year end. And when I say the next financial year end, just given the requirements of the tax, in fact, you'll probably have to do it before in some instances, before the 24th of October, because you can't actually submit the tax return without providing the master's information. So although there isn't an official, or the official deadline I understood was the 31st of May, but I want to say I think there's very few practitioners who've actually managed to maintain or to meet that deadline.
Okay, and then the second question is, with the UBO, what about non-resident beneficiaries? Must their information be disclosed and registered for SA tax?
So not necessary for SA tax, but certainly as far as the reporting to the master's office is concerned, especially if that non-resident beneficiary is a named beneficiary. So let's say, for instance, you've got a trust deed that says mom, pop, son 1, daughter 2, and son 3, and son 3 is non-resident, has immigrated, then yes, that individual has to be reported in terms of the master's UBO, and then by default, that individual is then included in the SARS reporting. It doesn't necessarily mean that just because the individual is a named beneficiary, they have to have a SARS tax number. There is information required, or you'd as a practitioner. I'm just trying to think whether it's on the tax return. There isn't a tax number, but there's certainly a place for a passport number. So if you've got an individual who's non-resident, you've got to give a passport number. It doesn't ask for a tax number at this stage. In connection with the UBO, though, that goes to the master's office, they do want to know citizenship, residency, and similar to the anti-money laundering, where at the end of the day a tax number has to be provided. I can see ultimately from a master's perspective we're going to need to do that. So in brief, to answer the question, yes, a non-resident or a named non-resident beneficiary or a non-resident beneficiary who's received a benefit in the past technically is a beneficial owner, and information needs to be provided for that individual or on that individual. Then having a look at the registration for the FIC for trust company service providers. It's listed in item 2 of the schedule. And then Directive 6 regulates the requirements for trust and company service providers. In that one, it also includes estate agents, attorneys. What's important here, I've put in the accountable institution. As a sole proprietor can also be an accountable institution. So in other words, it's whoever the person is that's providing those services for gain as an economic or as a business then as such, and it's not necessary that each individual in a profession has to be registered as an accountable institution. So let's say, for instance, you in a practice where there's multiple partners who sit on, who each have trusteeships. If it's the practice represented by Joe Bloggs as such, then it's just the practice that's the accountable institution. If at the end of the day it's Joe Bloggs, my understanding is Joe Bloggs then needs to be registered as the accountable institution with the hat on then as a sole proprietor, in that the trustee, the authorized trustee is Joe Bloggs and not Bloggs Incorporated as such. If it's Bloggs Incorporated and there's Joe Bloggs and Pitt, both neither Joe and Pitt need to be registered if it's the practice, but if they're back in their personal capacities, they need to be registered, each of them in their personal capacities as such. This was an important one in that from the legislation came in, and it was essentially effective by on the 19th of December 22, and everybody needed to be registered by the 31st of May 23 or within 90 days from commencing business. I've put in the website there. If you go in, the website is actually quite useful. I'm going to give you, when I tried to log in as a sole proprietor, it came back and it declined my registration. And then we went in essentially as a business, it accepted it, but with the understanding that it was just in as a sole proprietor, because it asks how many parties or people have you got a manual. So even as a practitioner, you need to have a risk and management compliance manual, which I'll go through now. But go in, have a look at the compliance page, and also look at guidance note number 7. It's actually a very good, it goes through all the general principles, and it's a very good reference source for just understanding what you've got to do when you've got to report, and the registration as such. In here, you'll see also.
Before you start the new slide, questions. With the UBO, does it apply to discretionary trusts as well? Because beneficiaries have no entitlement until trustees have declared a distribution.
So if they're not named as such, then they're not reported on until such time as that trustees exercise their discretion.
I hope that answers it. Cheryl, should I after each slide, I'm going to just stop you just to check for the questions. Okay.
Perfect. Thank you. And I'm sorry for that. And I don't want to play about to say I'm terrified I'll lose you folks. So I've got the screen, and yeah, sorry, but I appreciate that. Thank you, Danny. Then also quite an important one then is that you may require multiple registrations. So although I said Joe Blogs Inc. doesn't need to be registered if you've got, let's say, for instance, Joe and Peter's trustees. However, if you've got an organization that is provides accounting services, tax practitioner, or is an attorney, then you actually have multiple registrations in that instance with one practice. So it's actually your line of service as opposed to who the individuals are. Because as a tax practitioner, there's requirements that one has to register with FRC, and then obviously who the accountable body is. Likewise with the accounting and or attorney profession. So you might find that, let's say, for instance, you've got a practice that provides a number of services. Each one is going to be registered, but you do not need to register for each individual as out of each of the silos, the service providing, the service silos. I've touched on this risk management compliance program. Again, if you have a look, there's a really good template on the website. Sorry, I should have actually put the link in, and I can send that through if the slides are going through. But if you have a look on the FRC website, they've got a very good template that you can use for this risk management compliance program. And essentially, it's almost for those of you who have been involved in investments and need to do anything on the anti-money laundering as such, it's very much a case of, do you meet the client face to face? If so, have you done a worldwide check? Is that person a person of political, political interest as such? What is the business the individual's in? And it's essentially the manual that needs to be put in place, that if you're going to bring on a client, what is your assessment to make sure that from a grey listing perspective and anti-money laundering and terrorism activity, have you made sure that the client is not doesn't fit that profile as such. Just remember to customize your the manual to your business. That is one of, if the FRC come and do any reviews, you can't do the clause to say that you're the sole practitioner, you're the only one that's providing the services, you're meeting the client, and it's actually in my head, and I'm using A, my ethics, and B, my professional judgment as to whether I take a client on it all or not. Unfortunately, a manual is required to tell yourself what you actually have to do. I did actually check that in that I was running out of time for the 31st of May. So even as a sole practitioner, yes, you do need to put a manual together. Then I came across a really good piece of software that actually assists with the management risk assessment and the due diligence process. And coupled with it, it's actually a very good repository system. It's called eFika. It's actually was set up by, got hold of the gentleman eventually who did the wrote the program or was involved in the program, and he came from the Seifert days in the form of trusteeship at that point in time. So have a look at a software package called eFika. We're using it in our practice. It's a really cheap system in the form of it goes on a pay-as-you-go pricing. It allows for the worldwide check, and the worldwide check is important if you've got to do if you're dealing with any politically exposed people as such, any PEPs, or you're taking on a new client and you actually want to find out more about them. As I say, it pulls your sources from worldwide, and when you get the client to sign, they in fact give you your indemnities and your authority paperwork. The information is actually quite interesting what comes out. It also allows you to load supporting documentation. So, for instance, you can put in your trust deed, your letters of authority, your resolutions, your ID, your certified IDs that as trustees you need to keep. You can put in place for financials, deeds of amendment. There's quite a bit. And then also the bonus came in on the basis of in the CRPC where we've got to do those organograms for the shareholding. Because with this eFika system, it keeps going back up. So if you put it into, say, for instance, you've got a trust and who are the beneficiaries, it then it goes back up. So as soon as you put in, for instance, the on a beneficiary, it might be a company, then it asks the next lot of questions, who the shareholders or who the directors of that company, and it then follows that whole UBO process. So without you sitting down and saying, okay, how far do I need to go back up, this system actually does it for you. Just in connection with that UBO, I know Fia used it in one of her presentations a while back. This whole thing with the UBO, whether it's for trust or then for CRPC, because we've got to provide, and I think that deadline is actually the 31st of October for CRPC on the UBO. You've got to come back to whoever the warm body is. So it's not good enough just to say that you've got one trust and that's a beneficiary of another, and therefore I've dealt with this named beneficiary here. You've then got to take it one step up and say who's the beneficiaries and who the trustees of that next beneficiary, until such time as you actually get to an ultimate warm body who's essentially the final named beneficiary. I hope that makes sense. And as I say, have a look at the CRPC. This organogram and the UBO information is also required for CRPC. Previously, you could upload all the information in line with your annual returns. I understand there's a deadline now for the 31st of October.
Okay. Question for this end of the slide. So with UBO, does it mean the only individuals who have received a distribution benefit must be disclosed and not those who have not received a benefit, even though they are named in the trust deed?
No, if you're named and you haven't received a benefit, you've got to be reported as a consequence of being a named beneficiary.
Okay, thank you. I think that's all the questions for now.
Okay, great. Then there's also the UBO reporting to SARS and the uploading of information. Now, you can't actually submit your tax return, the trust tax return, without uploading all this information. Have a look at the e-filing wizard. But essentially, again, they're looking for that UBO master's prescribed format and uploading that Excel spreadsheet. You've got to upload a copy of the trust deed and the amendment, letters of authority, and then it says resolutions and minutes. Now, again, in our practitioners meeting, we had a discussion as to what resolutions and minutes, because if you've done a resolution to say that you're now moving from, I don't know, Alan Gray to Investec as a investment decision, must that resolution and minute be uploaded, or is it only the ones relating to vestings and distributions? And I want to say we made a decision amongst our practitioners group that we're only going to upload resolutions and minutes pertaining to the vestings and or distributions only, given the fact that this is SARS, and we're assuming that SARS at the end of the day want to understand which of the beneficiaries have received what amounts and during what tax, for the tax period as such. I know I've put in here vestings and distributions only, but I would also, as a trustee, and we do it, cover attributions as well. So remember, vestings are amounts that have been declared to an individual to be paid in that individual's or declared in that individual's tax return, but it doesn't necessarily mean that the trust has actually paid the monies over yet. So it's still there in a creditor capacity. On a distribution basis, the distribution has physically happened as such, and it needs to be disclosed in an individual's tax return. And then remember, you've also got attribution, and attribution comes in your section 7.8 anti-avoidance provisions, where it says that if you've capitalized the trust, then this deals more for South African trusts. If you've capitalized the trust on a interest-free or low interest bearing loan account, or it's being donated, then a portion of the income and or capital gain earned as a consequence of that, settlement, donation, settlement, or other disposition needs to be reported. And the reason I'm saying add attribution is when SARS get the financial statements, let's say, for instance, trust has earned R1,000 worth of interest income. The first thing you would do is essentially have a look at either the distribution or the vesting. So one beneficiary might have then, let's say, received 500 Rand, another 250. But as a consequence of the donor or the settlor putting monies into the trust, 250 Rand is attributed on that loan account. When SARS comes to do the reconciliation and they say, right, you started off with 1,000 Rands worth of income, you've accounted for 500 in the form of a vesting and 250 for distribution, where is the other 250? If you've included it in this resolution, you're answering a question already for SARS. So they're not coming back. I tell my team, try and give as much information to answer a question that if you didn't know the background, you wouldn't have to ask a second question again. So in your resolution and minutes, I would then add all amounts that are accounted for by a beneficiary. And remember, it's beneficiaries who are receiving the benefit in this one, who've either received something in the form of a vesting or a distribution, or a donor of the trust who has got an attribution of income as a consequence of an interest-free loan account. People argue and then say, or the comment back is, yeah, but it's a Section 7C issue on the loan account. Those are two different things, folks. 7C deals with the loan account and the interest on the loan account, and that's a measure of I want to say an estate duty issue versus the attribution, which is an anti-avoidance measure. So even though that loan account might be subject to 7C, interest on loan accounts, the fact that there is income that can be attributed back on that loan account, it needs to be reported to SARS. And then the last one that we make sure you don't get caught short coming up for February 2024 is that the trustees actually need to exercise their discretion and make a award in the form of a vesting or distribution before the end of the tax year. And I sent it through to Danny. It's quite a mass. It's our trustees resolution that we use. And unfortunately, I couldn't get it into the slides. It was such a lengthy or cluttered document as such. But I've added it, and I want to say use it in the form of it will help you come the end of February, because we've now got to do this whole section, or what's it, IT3T reporting, and I'll discuss that now. But it's a good mechanism to then say, as you would with your provisionals, this is the amount of our provisional income. Who are we distributing or vesting or attributing what to? And then come the end of the year, once you've finalized your set of financials, you can then ratify that decision and say, right, at the end of February, we attributed or we vested an amount to Joe Bloggs. Now that we've finished the accounts, this is the final figure, but at least by the end of the tax year, the trustees have exercised their discretion. What we've done with this one, and you'll see in the slide example that I've added to the pack, in there, I say a percentage amount. So let's say, for instance, you might be in a case of you distributing the standard or vesting the standard, call it, let's say, 23,800 for each of the individuals as far as interest is concerned. But then to two of the grandchildren, you're distributing the capital gain on a 50-50 basis. In order to make our lives easy, but the fact that we were still exercising our discretion, we said that the capital gain, regardless of what the amount would be split 50-50. You can't do that, unfortunately, now, because in terms of the new reporting for this IT3T, you actually have to put in an amount, because we're now going to have to pre-populate tax returns or tax information similar to what the banks and financial institutions have to do and medical aids have to do for their retirement annuities. So anybody who's got to pre-populate tax returns, us as accountants to trusts are also going to have to populate information by the 31st of May 2024. So I want to say, look at that template, manipulate it as you need to, but it is a hell of an important document that needs to be done by the end of February every year, from a tax perspective, and B, in your capacity as a trustee, or if you're supporting the trustees in their capacity as trustees, exercising their discretion and making the vestings and distributions before year end.
Just the question. So the question is: should we submit all the UBO to SIPC at the end of October?
So that UBO information is slightly different from the trust stuff, but yes, if you have a look at the CIPC portal, I understand there's UBO information required, especially with regards to the organogram and the shareholding. That's required by the end of October.
All right, yeah. Then the other question is about the template, which I did include with the notes. So those who have like that link to, it's in the chat box. I'll copy it again. There's two items. There's one for the slides and one for the templates.
And just tweak that template. You'll see, I think mine says 2021. It's the same principles. Just tweak it on the basis of you need to, as trustees, they need to exercise their discretion. Then just in connection with the IT12, I'm sure most of you have started that by now, because the IT12s are due, I think, by the 24th of October, and we're a little bit behind as well. But essentially all personal details, including the nature of the relationship to the trust, in other words, founder, controlling interest, donor as such, or lender. You've got to put in loan account values and the terms, and then details of, it says details of transactions applicable per beneficiary. I'm still not clear as to what those transactions are. Again, the fact that it's a tax return, we've limited it to tax information. I'm going to go through, because this is probably the more important one, is this reporting to SARS by the 31st of May 2004. This is that third-party data e-filing submissions. It came into place on the 18th of September 2023. And I was asked to interview for a publication the other day, and I said, it's actually quite easy to maintain that information or to get that information, because we've got to do it for provisional tax when you've got to do the reporting for your the income that comes from trusts. However, in connection with the capital gains, that for me is going to be the biggest challenge, in that normally we end up waiting to see what the capital gains comes in, especially if you've got a unit trust as such. And that's where, coming back to that example that I used of the template, where we put in percentages as opposed to rand amounts, now you're going to have to put in rand amounts. So as accountants looking after trusts, you're going to have got most of that information ready by the end of January, beginning of February, and have it pre-populated. There is going to have to be some sort of gap between what's been reported in terms of February and allowing for corrections. How they're going to do that yet, I don't know. When I was asked to put in a submission for SARS, I asked that we have, as an accountants or practitioners for trusts, we have till the 30th of June to submit that information, because we've got to get the banks and the financial institutions to submit theirs earlier. Their systems are, I want to say, more geared to providing that information, where as an accounting, you've got to then consolidate, especially if you've got a trust that might have multiple unit trusts. You've got to wait till you get that information, and you know that you only get the IT3C much later. So watch the space with regards to the IT3 reporting. It's due by the 31st of May, but it's very unclear at the moment as to the hows or the wheres. But again, here's a really good guide, and I put in the website. Have a look at that website. It explains right down to how you've got to actually get onto the software, and what you've got to, your URL link, and if you're submitting multiple information, I think it gives up to 50, and if you're more than 50 trusts that you've got to put the information in for, then you've got to get another system. But have a look at that external guide. It's a good document.
All right. Question from this side is, unpaid distributions made by the trust to beneficiaries, would that be considered as loans to the trust?
It is, but it's carved out of 7C. So it is a loan to the trust in no, it's yeah, sorry. It's so if you haven't paid it, if you've declared it but not paid it, the trust owes the money. No, it's carved out of 7C if that distribution has arisen as a result of an income or a capital gain that's been included in the individual's tax return. So no, it's not a loan coming back. It's specifically carved out of section 7C. I think it's 7C3 or 4 where it's specifically carved out.
Okay, thanks, yeah.
Right. And then the other one, this is more of a case law. So we've dealt with the Master's Office, FRC and SARS. There's a huge amount that's required then from that point of view and paperwork. The other important one is this case law that's come out now in connection with the majority of trustee decision. And I will very sadly admit that I have breached this probably twice in my career on the basis of where we again waiting for letters of trusteeship or letters of authority rather. And a decision's been made to, let's say, for instance, change investment advisors or to sell a property. I've said, make the decision as majority of trustees. The fact that I might not be on there yet as a letter of authority or as a trustee, there's 2 out of 3, you're fine, make the decision. It's actually wrong. And I've got Trevor McGlashan from our Deloitte days in the 80s explaining. If at the end of the day, you've got 3 trustees, all 3 trustees have to be party to a decision in order to reach a majority. It doesn't mean that all 3 trustees have to agree. If you've got 2 that disagree and 1 that agrees, then you don't have a majority vote. If you've got 2 that agree and 1 that disagrees, you've got a majority vote. But you can't be in a position where only 2 ask the question without asking the third. That's not a majority vote. And in this Shepson and Wiley court case that came down in May 2023, it was then confirmed that at the end of the day, a majority of trustees cannot make a decision without consulting the minority. And this is quite an important one, folks, especially, and that comes back to my initial page where I've said all trustees should be party to the outsourcing of information. It doesn't necessarily mean that they need to agree with it. So let's say, for instance, you've got two trustees agreeing to outsource the information, or outsource the administration rather, to Joe Bloggs, and the third trustee says no. 1 and 2 have agreed, you can still outsource to Joe Bloggs, but the third trustee who disagreed still get that individual to sign. And if there's going to be, I want to say, a controversial case on the basis of a yay or nay, usually at the bottom box, and I'll show you in the next slide quickly what we do with regards to round robin of resolutions. If you think that there's going to be a yay or nay answer with somebody not in favor, add that to your signing block. So your signing block, you will then have name, signature, date, and then almost as a for and against. And they can then say yay, yay or nay. But really, really important nowadays, check. You can't have, and this comes back if you're administering a trust, or you're a trustee on a trust where mom and dad are your co-trustees, and they make all the decisions, and then once the financials are ready for signature, then you have the trustees meeting, and then everything gets signed off. If they've made a decision before that trustees meeting and you've ratified it's happened, and mom and dad have decided over the breakfast table that, yes, we're going to sell that piece of land, but they haven't included you in it, that decision is null and void. It's not made by a majority of trustees. So this is more of a legal issue, but just remember this is a hell of an important one if you're acting as a trustee, and I'm going to use the word as a passive trustee, in that you're wearing your hat on as the accountant and or the attorney, and by default you got roped into being a trustee. Remember, you've got a very other important hat on as a trustee. Don't get caught in that trap. What we do, and I'll just finish the next slide, is you need to see that your trust deed allows for the execution as such. So in other words, it allows for a round robin or circulation rather than of resolutions. We put this at the bottom of all of our resolutions where we emailing resolutions out, or emailing documents where we say maybe this resolution may be executed in a number of counterparts, each of when signed shall be an original, while the counterparts together will constitute one and the same resolution. So let's say, for instance, you've got a resolution to change, I don't know, a bank account as such, or change investments, and you send it out to the 3 trustees. Each of them sign and send it back, but then you've only got Joe Bloggs on the one, you've got Peter on the other, and you've got Mary on the third one. You will then have to submit 3 separate documents, but the 3 documents constitute one original document as such. So, and then coupled with that, check that your deed allows for, as I say, round or circulation of resolutions. So in other words, not everybody has to be together to sign at the same time. And then also add in to your trust deed and see that electronic communication is a valid and acceptable form of communication or paperwork distribution as such. I would put that into trustees going forward, especially given the nature of the way in which we operate now. We don't send stuff in posts anymore. You send the email, they Adobe sign it or print it out and sign it if you're dealing with somebody who's challenged, and you get it back then as such. Are there any questions then in connection with the case law?
Question I got is, sorry, me again. If unpaid distributions are carved out of Section 7C, would you tick the box on the tax return? Was a loan advanced to the trust?
No. There is no loan advanced. So this needs to go, sorry, in fact, you know what, just coming back to that one. So the answer I would still say no, is you don't tick the box because it's not a loan that is advanced to the trust. But what you do, in fact, there's two questions or 2 points. It depends on whether you've said to your beneficiary, here, I'm going to pay you, and the beneficiary says, no, I don't want the money. That's a different scenario to where your trustee exercise or the trustees exercise their discretion but delay payment. So just make sure very carefully that that payment is not at the insistence of the beneficiaries, but it's been withheld by the trustees. And the trustees have got full discretion in which to make payment. So just be careful on the basis of, one, you making the payment, but your beneficiary then says, no, I don't want it. That then could be seen as a 7C loan back in as such, which is a difficult one. How would you, I suppose from an accounting perspective, sorry, I'd probably take it out and then bring it back in again, so you can show that as trustees you've discharged your liability to pay it. That's a different scenario to we're going to vest money to you, but we're going to delay the payment. I know that might have created more of a question. I'm not, does that answer it? But if the trustees haven't paid it and it's at the trustee's discretion not to pay, no, it's not a 7C loan. Can I move on then from the majority?
I think we can move on.
Okay. Then this one has become quite, this in connection with the foreign landscape. Oh, sorry, folks. And I've dealt with, you'll see here, the UK citus tax and the UK issue, because we seem to be in a position at the moment where a number of our beneficiaries are going to study in the UK or applying for ancestral visas in the UK. Years ago, I had a question from a client that said, if I've never been to the States and never been to Disney World, but I own Disney shares in my share portfolio, do I have a citus tax issue? And the answer was yes. This now from a UK point of view, and I'm picking only on the UK, I've used the UK as an example. Again, the answer is yes. And I just want you to see how extensive the foreign trust landscape is with regards to understanding taxes, who needs to be registered, and in what capacity. Just give me one sec. All right, so there's still extensive AML, KYC being know your client, AML, anti-money laundering, and then we've also got the CRS, the Common Reporting Standards. I've had 2 clients in the last 18 months who have been queried on Common Reporting Standards. So yes, it is working. I remember sitting at a Treasury meeting a few years back, and the comment was made, we will work through the reports. We're obviously going to go to the low-hanging fruit. So it's there, it's happening, the sharing of information across revenue authorities. Then there's one that has been around for a very long time, but it's now being exposed more because we've got UK citus assets, and also because we might have beneficiaries. This is now, and folks, this is offshore trusts, and regardless of where the offshore trust is registered, so it's any trust not registered in South Africa, this essentially applies. So you could have a Mauritian trust that could be a discretionary relevant property trust in the UK for a number of reasons. One, in that it owns a UK citus asset. So it might have then, for instance, a UK registered investment portfolio, or it might have a UK property. And because it's got a UK registered asset, it automatically deems that non-resident trust from a UK perspective to be a relevant property trust, and a trust that then needs to be reported on, and I'll show you the reporting, but more importantly is taxed. And from a taxing perspective, and this is dealing only with the trust, there's a IHT inheritance tax that's levied every 10 years. It's known as a periodic or principal tax. And basically what happens is every 10 years, it rebases the value of the trust. It then calculates almost a CPI as such, and then you pay tax. Well, in fact, it's a CPI at 6%. You pay tax, or the trust pays tax, essentially on any capital in excess of the 6%. So it's essentially a form of paying inheritance tax over a 10-year period based on growth within a trust. I want to deal, before I answer questions, the next part with dealing with this, the UK registered assets, because, and I'll give you an example. It came out again with a client the other day where his son is now studying abroad in the UK, and because he's studying abroad, he ended up buying a flat held via the trust. And once we'd unpacked everything, we've now got this tax charge on the trust for capital appreciation. As I say, it's a rate calculated based on the market value every 10 years. And then the fact that, and I'm quickly going to jump down here, the fact that you've got a UK beneficiary that's got registered, whether it's for schooling, university, working there, or permanently, the fact that that child is now studying abroad has brought this Mauritian trust into scope, and just one UK resident beneficiary brings the entire trust into scope. This is if they've got UK sourced income. So don't worry if you've got a situation where a child's working or living in the UK, but all your investments are in the States. That's not a problem. It's a problem if you've got a UK registered asset, regardless of the nature. Bank accounts, though, at the moment are excluded, but what's not excluded is money market and bond unit trusts. So again, people need to be very careful with regards to the nature and the situs issue with regards to what are their portfolios in as such. So just coming back to this periodic tax, if you've got a UK situs tax, it's a registered asset. A second point linked to it is if the settler is not excluded from benefits. So in other words, the person who creates the trust and retains a potential interest in the trust as the beneficiary, then you've got what they call GROB, which basically stands for gift with reservation of benefits. And on the death of that settler or the individual, a portion of the assets held by the trust may fall within his or her estate and be subject to inheritance tax. That inheritance tax, folks, in the UK and the US runs at 40%. In the UK, rather, it's any amounts over £325,000. And just a quick one, that £325,000 is for husband and wife. So dealing with any UK beneficiary, UK registered trust, UK registered asset in an offshore trust, you could end up having a UK situs issue. And in fact, I'm going to correct myself. If it's a South African trust that's also got UK registered assets and you've got an individual there, you could end up, because remember your South African trust is foreign as far as the UK is concerned. So just be very careful and understand what is a UK situs or a situs asset, and that's applicable for any immovable property. Situs basically means where it's registered or situated. So, for instance, if you've got property in Portugal, that's a Portuguese situs asset, and on the death, that Portuguese property may be subject to Portuguese estate duty. Likewise, in the with any immovable property, but specifically for non-UK trusts that have got UK registered assets, you certainly from that point of view, there could be a need to register your trust, and I'll go through it this way. Here, I've brought in just in connection with the situs assets, including investments that are UK registered, any offshore assets which are previously held by your foreign investment allowance, or now the Authority for International Transfers, are included in a South African's L&D account or estate and subject to South African estate duty. But ownership of the assets might also vest in some foreign currencies, and therefore, or countries rather, and might also be liable for duties as well. So this has a huge impact on, or could have, in connection with probate, and I'll deal with that just now, but also in connection with the liquidity of an estate. I've often been asked, and again, over the last probably 18 months or 2 years, there've been again 2 incidences where situs assets and the implementation of inheritance taxes has been included in specifically in these instances in the US, is because if you think that opening a bank account in South Africa, where individuals now have to go into the bank, and if you've got trustees, the KYC and the information that's required in order to open a bank account, try and do that with a bank account in the US, or on the death of an individual to try and change an investment into a beneficiary's name. Sorry, the paperwork is hectic. And unfortunately, from a South African point of view, with us being on grey listing, sorry, just give me a minute. With us being on grey listing, and the fact when I had a conversation with a US person wanting to know why they were, I asked specifically, why are you interrogating our South African resident clients so extensively? It was, your governments are in the paper quite frequently because of financial misappropriation and the grey listing, and therefore before we take a client on, we're checking. So sorry, I seem to be going in a bit of a circle in this one, but what I want you to say is that you might have a foreign registered asset, either in your own name or via a trust. Those assets are definitely subject to, in their own name, subject to South African estate duty. Your trust is obviously South African then as such, but beware, you could end up with a taxing implication in the US or the UK, or if it's immovable property in that jurisdiction as a result of a situs asset. And comments have been made, but we little from a South African point of view, we're ineffectual, we're not on the radar. The answer is we're very much on the radar first. And secondly, all revenue authorities are looking for money. And you've got your risk compliance officers in all financial institutions that the minute you change a beneficiary from A to B, there's a paperwork trail. And in that paperwork trail, if it then comes out that A was non-resident and it's a situs-based asset, in other words, a registered asset in that country, and a registered asset is, for instance, Apple or Amazon, they are US-based assets, they could then very well be subject to a situs tax, and very much so or more so if it's held within trusts, because you've got an obligation, or the trustees have got an obligation here that a UK trust becomes a relevant trust if it's got to pay any of what they call the relevant taxes, which is that periodic tax charge. And like we have to do in South Africa with the UBO, the trustees have to submit an information register called a trust register to the HMRC, and relevant trusts then are essentially any trust that receives income or has an asset that's registered in the UK. Yesterday, I had a client tell me that trust compliance in South Africa is becoming expensive, and as my comment was, you're still paying in rands. Do this exercise now, your UBO exercise, and pay it in pounds and see the cost. So what we've gone through from a South African point of view, it's arisen as a result of more of our grey listing, but like I've said, every revenue authority is looking for money somewhere. And here's a prime example with regards to UK. The UK are actually looking at non-UK registered assets, or trusts rather, where they held assets, or as I put in, you've got a beneficiary who, as a result of being resident in the country at that time for any reason, brings the trust into scope as making it a relevant trust that needs to be reported and needs to be taxed on in the UK. And I'm sure there's going to be a number of questions on this one. I want to say it's a case-by-case basis. You need to look at the situation. You need to understand how your investments are registered and managed. So if you, for instance, got a share portfolio with bespoke counters, that share portfolio could be a problem in that it could own, let's say, for instance, Sainsbury, and it could own Amazon. Yes, you've got a CITES issue there. If you've got a unit trust that's registered in, I don't know, the Bahamas, or the BVI, and it's got a number of portfolios or monies within that, no, that's not a CITES asset, because remember, the owner or the trust owns the unit trust, not all the underlying investments. So you've got to unpack and have a look at exactly what is a CITES asset. Up until a few years ago, just giving you a quick example, if clients wanted to purchase UK property, the trust held the property directly and there wasn't a problem. Then probably 8 or 10 years ago, they introduced envelope tax. They've been the UK authorities, and that was basically aimed at non-residents, so non-UK residents who held property abroad. There was then a taxing. So then what happened was you took your property out of the trust and moved it into a company. In the UK, now that also falls back in with the relevant tax, because you've got a company that's registered in the UK. So then you moved your company to, let's say, for instance, Mauritius. But again, because there's still a direct link, that trust is still taxed. So it's folks, that international, the cross-border consulting as far as beneficiaries and residents, CITES tax, and who's ultimately responsible somewhere for tax is a minefield. Danny, I'm not sure if there's questions in connection with that. It's quite technical, and as I say, it's very bespoke.
No.
I don't want to spend
too much.
There was only
a question to confirm what I think where you were saying your abbreviations, but I think it's your foreign tax allowance or foreign investment allowance, and it was approved international.
Yes.
That's two abbreviations. Yeah.
Correct. It's your foreign investment allowance that's now become authority for international transfers.
Yeah.
And the reason it's become authority for international transfers, that's also fairly new. That came out in April this year, is that now the Reserve Bank has moved all authority for remitting funds abroad, whether you're doing it in the form of a foreign investment allowance or you're doing it as your immigration, that's now all been moved to SARS, and your authority, your foreign investment allowance is limited to 10 million. But in terms of your ART, your authority to for international transfers, that could be previously your MP336 immigrations, or it could be any amount that you wanted to remit in excess of your 10 million rand, or it's your 10 million rand. So they've just consolidated it all in under one heading as such.
And then the other comment was, do you want to take a 5-minute break, or do you want to push through? I don't know. We're a bit behind, so.
I'm fine if you don't mind. I've been manned down last week with the flu, so a little bit rusty. So if you don't mind a cough every now and again, I've got my water. I'm fine. If you want to take a break, happy. Otherwise, I'm happy to push through.
I think let's push through because I think we're a bit behind on time.
Okay, great. So that's the foreign landscape. Now, the big one now at the moment, and so looking here now, are trusts still viable planning structures? It always depends. What was the reason for setting it up in the first place? Understand the cost benefit now. In order to get money into the trust is expensive. In order to get money out of the trust is expensive. And you've got all this regulatory reporting. Given that, is it still worthwhile having trusts? And ultimately, I want to say yes. You just need to come back and see what is the rationale for setting it up. If it's for tax planning and tax saving, folks, you're wasting your time. That net is just getting broader and broader, with the holes in the net narrower and narrower, and you will get somewhere along the line, it will come into some worldwide taxing. I'm also going to make a really controversial statement now, and I'm going to say that and this is based then on the next couple of slides, the landscape as far as the South African trust industry, I think is, we've just had a shake-up in connection with the UBO, and should we keep these trusts, and what is the viability of them, to now with this next piece of legislation that's coming out from the 1st of August. And that is going to be, here I'm going to do it, it's this worldwide one, in that previously trusts, South African trusts, couldn't remit and hold direct investments. You always had to come out, take the monies out of the South African trust, put them into the individual's name, and the individual then took it abroad. That changed now on the 1st of August. And probably 20, 25 years ago, having a conversation with Barlow's director at that time, a captain of industry, when we've got our first foreign investment allowance, which I think was about a whole 250,000, and that was about 1998. I remember him saying, if you sat on the moon and you could hold entities anywhere and you could invest anywhere, you wouldn't do it all in South Africa. And given this now, the fact that South African trusts can remit directly abroad and hold to offshore trusts, I can't honestly eyeball a South African client nowadays and say, set your trust up in South Africa. So let's unpack that and have a look at it, because I think it's quite far-reaching. So like I said, previously, SARS would not allow the release of funds for South African resident trusts to non-resident trusts. This effectively undid the whole estate planning. So people who had trusts that were set up for years and years and years, and then didn't want to go via the asset swaps, they wanted to use their 10 million rands abroad. In order to use those 10 million rands and get the monies abroad, they had to liquidate investments, either distribute it or send it on a loan account to the planner, who then had to apply through SARS for a foreign investment allowance and then take it abroad. Taking it abroad either went on the basis, if you had, similar to one scenario that I've got with one client, where as soon as every child got to 18, they were registered for tax, but they got their tax number as such, and they got 10 million rand on their 18th birthday loan to them for them to take abroad. That client now, we're sitting in our trust with a trust capital of 300 million and a loan to beneficiaries of 300 million. I've got nothing in my trust. Everything is now sitting offshore. If this scenario had been in place where SARS allowed tax and South African residents to remit abroad, we would probably only have 60% overseas, and we would still have a South African trust. As I say, that landscape's changing. So, and the big negative was you'd set up these structures for all good reasons, being estate planning and income, capital protection or third-party protection, and now as a result of exchange control, that was undone. We can now do that with effect the 1st of August. I do know of one practitioner who's done it, and they applied for 150 million, and the 150 million was allowed. And funny enough, it was actually allowed quite quickly, quicker than some of our immigrations and or excess of 10 million rand allowances were going through. But essentially, SARS has now clarified its stance on it, and it's basically said that we will allow it to happen, but we want to make sure that all the boxes are ticked and taxes are paid. In these slides, folks, I've put in some planning, or I've put in some points, and you'll see it more on the next one, that could be, again, controversial, but there's no answers. And I think it's important to put it out there, because the more we put it out there, the quicker we can get clarity on what is SARS's thinking. So when we provide advice to a client, our advice is, I want to say, clearer, a whole lot clearer than mud. And let me explain those to you. So just quickly, SARS has now said, okay, we'll allow approval for the release of funds or amounts to be distributed abroad. It's got to be in terms of the trust deed. So again, that by de facto, I'm a little bit confused as to why it's got to be in terms of the trust deed, because if you're making an award as a trustee, it's always in terms of the trust deed. It goes on further to say the non-resident trust must be a beneficiary of the South African trust. What is unclear, though, is whether that offshore trust must be a named beneficiary or a class of beneficiaries. So, for instance, in our trust, we've recently tidied them for electronic communication and removing the list of all the beneficiaries, named beneficiaries, and putting it to classes. We've used the definition the trustees in their capacity as such of any other trust established in any part of the world for any of the foregoing, a foregoing being, let's say, for instance, mom, dad, and their descendants. So that if that clause is in, as I say, I don't know, and I don't know what SARS's comment is on it. From a legal point of view, that trust, that non-resident trust, is a beneficiary because it's a class of beneficiaries. It might not be named. The other thing SARS then want to have a look at, or how do you do this now? It's essentially a manual process. And you've got to apply for a manual approval letter of compliance. And the compliance is for your trust as well as for the beneficiaries. They're not actually looking, I went to go and look at the information. They're not looking at the offshore trust as such. You send the email to this MLCA address. SARS are going to verify it with strict interpretation of the relevant sections of the Act. Now, in terms of the relevant sections of the Act, I'm going to jump down one and ask the questions that we as practitioners within our group have been asking in connection with this. you can't do a trust-to-trust distribution for capital gains. However, you can do a distribution to a beneficiary of an asset and then have that beneficiary then pay the gain on it. So again, my question is if you distribute an asset to a beneficiary and that beneficiary is a non-resident trust, does that mean that the local trust is then exempt? And in terms of the 8 schedule, it's then correct in that if you distribute an asset, it's the beneficiary that then pays the capital gain. If you then distribute into a trust that doesn't, or a beneficiary that doesn't have capital gains, like for instance, the Mauritian trust, does that mean it's then exempt? I'm going to, I can't answer your question. I am going to say, coming back to that, if you look at point 4, the South African resident trust must demonstrate that all tax liabilities in respect of that distribution were or will be settled. One of my colleagues' comment was, well, if there's no tax on it, you can still demonstrate that it's not a taxing, it's not a tax event as far as South Africans concerned. So this is, here's just information, the provision of your compliance. I'll come back to that, but just coming down again, your tax considerations. I don't know if there's any questions. I had to consult to somebody this morning and they had no idea. I was asked to consult to setting up a South African trust, and I said, don't set up South African trust anymore, go and set it up in Mauritius, and you can have your Mauritian company then own the shares here. And the guy said, but I've got a trust here. I said, but you can then distribute those assets offshore, and you, in a perfect scenario, South Africans, we wouldn't really have 2 trusts. And we've got 2 trusts because previously, as South Africans, our trusts were not allowed to hold direct investments abroad. So what did we do? We had our South African trust. We undid it slowly, 10 million at a time, until such time as we had enough money to justify either putting it into a trust offshore, or we said, okay, we want to move the monies into offshore trust. So we essentially have a South African trust and a Mauritian trust, or a Guernsey or BVI trust. These trusts couldn't talk to each other directly because of the South African authorities, and it went out via your beneficiaries. That has now changed, and technically, from the 1st of August now, your South African trust and the Mauritian or the BVI trust can overlap. And therefore, I'm going to ask the question, as a tax practitioner, and not a tax practitioner, as an accountant or a consultant to clients, are we giving best practice advice if we tell our clients, yes, then keep your South African trust, or no, terminate your South African trust, take your knock on whatever you're doing in the form of your capital gains. If your objective is still to get monies abroad, and then migrate your South African trust into your Mauritian or the Guernsey, Jersey offshore trust. So I think this as far as South African tax planning for clients wanting capital protection and country and currency risk, this for me is a major game changer, and it changes our local industry. Can I pause there for a minute and come on screen just to see if there's questions or people's comments in connection with this? Danny?
Yeah.
Oh, hi. No, I can see in the chat.
No, that was just me posting the notes. I don't know what question you have open.
I've been
keeping a track and
yeah. Folks, it's a new one. If there's no questions, then I'm going to then just continue then with the sharing as such. Please don't tell me I've destroyed.
Yeah, I think you cancelled your sharing. Just go back to share. Go back to share.
One. Where is? Flip. Are you there still?
Yeah, I'm still here.
Okay.
You need to go back to that web page and just look and click share. There has become a question now though, but let's first get your screen back on, and then we'll just check this question.
Okay.
All right. And just remember then to click that hide first.
Yep. How's that? Okay.
Yeah. The question is award to offshore trust taxable ITOB para 82 80 brackets 2.
So that's the capital gains then. So then the answer is, if you invest in the capital gains, then the answer is yes. It's taxable, and then the big one then is that you can't vest to a non-resident, and therefore it's taxed in the South African trust. So the answer, so it depends on what you're going to essentially distribute. If you distribute an asset, then it's your beneficiary that's liable for the capital gain when the beneficiary sells. If your trust sells and then distributes the cash, your trust is then liable for the capital gains tax. But then that's where, in terms of the conduit principle, then you then made the vesting to South African resident beneficiaries and then had it taxed in, sort of, you did the multiple tax splitting. So then I want to say be very careful, and that's my first consideration, is my first point, if you're going to sell the South African portfolio and distribute cash offshore, you can't then vest the capital gain. Or my question is, if you've got sufficient trust capital retained income in your financials, then yes, you can do that, but you can't sell the asset, vest the capital gain into your beneficiary's hands, your South African beneficiary, and have it taxed in his or her hands, and then make a capital award to a non-resident beneficiary. If you've got to do the T account, so you've got to actually follow the journals through as such. But it depends on what you are distributing. Now, in my mind, and I want to say I'm wearing a hat on then as the tax practitioner, the fact that at the end of, as SARS, the fact that SARS want to actually check that South African resident trust will pay tax, I don't think it will be a viable plot to say you're going to distribute the asset to a non-resident beneficiary, and then that non-resident beneficiary needs to pay the tax.
Well, the follow-up was the capital gain, in my opinion, will always be taxed in SA Trust if vested in non-resident.
Correct. I want to say I agree, but I just, if you distribute the if you distribute the asset though. Yeah, I'm trying to, I must be honest, I tend to agree that at the end of the day, given the, the substance over form on this one, at the end of the day, this isn't a tax avoidance exercise. This has got more to do with the fact, and if you read the paperwork or the understanding behind it, it comes back to the fact that previously, SARS disallowed the practice, and now they're saying, well, there's no reason why local trusts can't hold direct investments, or so that at the end of the day they still can't hold direct investments. They can, however, make a distribution to directly to an offshore trust. I just want to go through and make sure that we've covered everything. As I say, it's unclear as to, it says the non-resident trust must be a beneficiary. I don't know, I can't answer whether it must be named or a class. This is the procedure in which you go through it as such. This point 5 with regards to the supporting documents for obtaining approval for the international transfers, it's a very good source document, to see what's required in the form of any foreign remittance, whether it's your 10 millions, whether it's immigration as such, or additionally now your trust applying for funds to go abroad.
Yeah, now the follow-up again is, I think the reason why SARS is allowing award to offshore trusts is that SARS knows that they will receive capital gains tax in para 80.
Yeah, that's my view as well. So the comment on this trust-to-trust distribution and the fact that you invest in an asset, yeah, I must be honest, that would be my stance, and I wouldn't. I want to say I wouldn't play silly buggers on the basis of trying to be smart and clever. You're right. What is the reason for doing it? It's an unpacking for capital gains. At the time, though, in the format, I'm not an investment advisor, just given the current market environment, it's actually a very good opportunity for your local trust to look at liquidating assets, moving abroad. Just remember, you can't distribute a capital loss. So you might end up with losses in your South African trust that you can't use.
Cheryl, I don't know if you're there because I don't know if you broke up.
In the form of using the moon, you wouldn't have two trusts. Can I continue then on the next bit?
Yeah, let's continue.
Okay, so this one now is, so that's obviously what we've just gone through is the new planning environment, but up until now, this is what we've been doing with trusts, and I want to say we haven't gone as far as to say, okay, how do we unwind everything that we've done, collapse it all back into South Africa and then tidy it up? So part of this webinar then dealt with, and it had to do when I started to put it together, it was trusts and foreign estate planning, and I think that's the basis on which I've continued with. So first of all, to get funds out of the South African trust, you either had a loan account repayment, or there was a capital award, or what people use quite frequently, so there was a loan account repayment of your initial funding, or you did it on loan account. And the loan account was then to say, right, we'll loan the beneficiary 10 million rand. Beneficiary, you then take it offshore, either invest in your own name if you don't think it's viable to set up the trust, or move the monies into an offshore trust, again on loan account. From a estate planning point of view for your South African planner, you had a liability of the 10 million. So in other words, they owed, that individual owed the trust the 10 million back because it was loaned on a loan account. And then they had either the investment or they had the loan account or the offshore trust. So from an estate duty perspective, it was kind of, it was zeroed out, your asset and your liability. If obviously the investment, the offshore investment was held in own name, it would have only been the growth that would have then been subject to estate duty. And that, so I want to say, if I have a look at, and over my time of looking at trust structures, probably 80% or 90%, if there wasn't an initial funding loan account, those 10 millions were done on a loan account basis. One of the questions when we did estate planning was always to make sure that if you were transferring those funds abroad, did you have sufficient assets from a South African perspective to repay those monies to the trust if you had to, without then undoing the whole offshore structure and then having to repatriate funds to South Africa to repay your trust on death. So this, because remember, when a trustee can't disregard their obligation for calling up loans or assets due to it. So I'll show you, and we'll go through that now with regards to planning. So we've had a look at how we get funds out of a trust. Getting funds into a foreign trust or company structure. It was either a loan to a trust or the company, or you acquired subscription shares in the company, or there was a donation. I know I had one client that basically said, I don't want to be in the position where any of my foreign direct assets could then be brought back or forced repatriation to South Africa. So I'm going to pay my donations tax, and the funds must then be held by my offshore trust. As far as the capital component, 100%, that he paid the 20% donation tax, and that was fine. However, the Section 7(8) attribution rules applied on the income and para 72 of the 8 schedule, and therefore capital gains earned by the trust in that instance, there was attribution back to it, although it wasn't a South African dutiable estate. The million-dollar question then always was, in which jurisdiction should you have then set that offshore trust up or the structure up, and in what currency? I know from a currency point of view, for our section before the introduction of Section 7C, and you just had your Section 31 transfer pricing, I know people were then using yen and Swiss franc and all other currencies where they were either negative or low. That scenario has changed slightly. So again, coming back to which jurisdiction and which currency. From a jurisdiction point of view, I think always look at what's a stable environment, both from a political and a regulatory perspective. And the big one is, if you've got to litigate, you actually want to understand the law in which you're litigating in. So therefore, don't, sort of go to Outer Mongolia in the form of setting up trust then as such. Rather, the view always was to have a sound principle in which if the trustees needed to litigate, there was a basis in which to do it. The other one was, and for a while, up until a while back, it was, has that trust company got a presence in South Africa? So then you would have the, I always call them the suits, coming in from Guernsey or the Jersey or Isle of Man, and they would come out to South Africa. They would enjoy our sunshine and some great red wine. They would meet with the client here, essentially do all the resolutions, have the discussions in connection with letter of wishes, sign the financials, etc. And then they would go back to the Soggy Islands. The problem with that now is that if you're dealing in South Africa and you're making those decisions in South Africa, be very careful of your place of effective management. So to that extent, I'm very reluctant and very careful that when we actually meet with the offshore trustees in South Africa, it's not in the form of a trustees meeting as such, or a settler discussion. Any decisions or any signing or any, I want to say, decision-making process that needs to happen abroad. Accessibility to the trustees' offices. Mauritius, for argument's sake, is 4 hours from South Africa versus having to fly all the way to Guernsey or Jersey. accessibility to trust officers. It's an important one. It's not the be-all and the end-all. One that's becoming important, though, is now your setup and ongoing administrative costs. As you can see, just in connection with opening bank accounts nowadays, I want to say it's taking almost 6 to 8 months to open bank accounts in Malta just because of the paperwork required and their regulatory environment. And you've got people that are then charging 15 minutes per euro. It becomes hell of expensive for the administration and your setup costs. And then an important one now is where will beneficiaries reside? And I'll touch on the circle, or that infinity circle that you could end up doing to say the what ifs. So what if I've got a child that might end up in Australia, then we don't set up a trust? Or what happens if I've got a child that might go to the US, and therefore I must rather do a grantor trust in the US? You can't continue. You need to actually get to a point to say, keep it simple, use it at a point, what is best practice for now, but make it as flexible as possible, that if you do end up having beneficiaries that then become US resident, before they become US resident, what do you need to do? So from a jurisdiction point of view, for me, it would be something that is stable, something that we understand as far as the law's concerned. And yeah, I suppose having that relationship, because the big question is, in South Africa, you have mom, dad, and the best friend as trustees, and there's some sort of control. When you take your funds and put them into an offshore trust, those trustees have essentially got control of those assets. Yeah, you might call up your loan account and you might have some financial control in the form of your loan account and getting your monies back. But with regards to a decision-making process, that decision-making process belongs to the suits on I want to say, Soggy Islands. Mauritius has become a great one. So having a relationship with your offshore trustees is then quite important. With regards to into which currency, South African or foreign denominated, I have been, and I do advocate the Swiss franc, and my Swiss franc, and I can honestly put my Baden Powell, what's it, Boy Scout thing, is that Swiss franc has always been a neutral, stable currency. If you look at the reporting that we get in the form of our investments are very seldom done in Swiss franc, other than we might be investing in Nestle, and maybe two of the pharmaceutical countries or companies rather, but our reporting and our base cost as far as our investments is usually either the euro, the pound, or the dollar. So to that extent, the Swiss franc as a reporting currency or as the administrative currency for the trust is a viable or a plausible, not viable, is a plausible currency. The big one is, as trustees, borrowing money from the South African set law is you need to support that decision as to which currency they're going to accept the debt in. And then also, if you are going to remit, and I'm busy with one now at the moment for a client, and we've decided that we're going to go the Swiss franc route. And when I saw the paperwork with regards to what the banks were doing with regards to remitting the funds, they were then going to remit in dollars. And I said, don't do it in dollars. If we're doing a Swiss loan, you remit in Swiss francs. Unfortunately, yes, you are going to have a currency knock on the conversion then from Swiss francs into dollars when the investment advisors or the asset management companies invest, but keep your substance. I've got a Swiss franc denominated loan, and therefore I'm remitting in Swiss francs, and why am I doing it in Swiss francs? If you do it in a Swiss franc or a foreign denomination, then this is your loan to your offshore trust, you've got the interest rates are a whole lot lower overseas than they are in South Africa. So from a ongoing basis and your immediate dry tax, it's a lot less in that your interest income that you're disclosing, your foreign interest that you're disclosing in your tax return is less than if you were using your South African rates. But then remember, your currency variance on death, your estate duty, you're not pegging the value. And I had a query on an estate about 6 months ago with the gran that died, and funds had been awarded to her as such. And the SARS estate department came back and they actually wanted to know what was the initial amount in which the loan was remitted and what was the current one, and they've taken into account a variance in as far as the market value for the L&D account. So if you've got a fluctuating loan account, you take into account your currency variance on a South African denominated loan account, at least you're pegging the value, but you've got a higher outflow each year. On a South African denominated, if it's not interest bearing or it's less than market value, then your 7C kicks in. This is then on your ZAR denominated loans. And then your prescribed interest rate now at the moment is running very high at 11.25% for May. If it's a foreign denominated loan and you're using the Section 31 interest rate as such, then it's whatever your reporting currency's central banking rate is +1. If you don't charge interest on your foreign loan, remember, then you kick back into Section 7C as such. Although when I say you kick back into your 7C, it's essentially your SARS prescribed rate. It's not just 7C rules, because you're still making a foreign denominated loan to a connected party at a 0 interest rate. So therefore, if you're not charging an interest, you're essentially using the SARS prescribed rate. So it's a toss-up whether you want to take the currency risk for estate duty purposes, or whether you want to end up paying less amount of tax on a annual basis as a dry tax. Are there any questions on that before we just have a look at the setups and the options and the structures that are available?
There's no question at the moment. We can carry on for now.
Okay, perfect. So then let's have a look at what are the type of structures and setups there are. The one is just your vanilla standalone inter vivos discretionary trust, where your capitalizing mechanism is mainly an interest-bearing loan to that foreign trust. So remember, this is all dealing with foreign trusts. You've taken your funds abroad and now your money is sitting there. You want to put it into a structure, not in your own name. What are the options available? So it's your standalone discretionary trust. And again, the same client that I was telling you about with the dollars and the Swiss franc, where we're now going to distribute or transfer in Swiss francs. Once we'd had a look at all the scenarios, here's a vanilla traditional creating a trust. And the reason for creating the trust is that his kids are 18, 21, and 23. He wants to capitalize the trust with 100 million. Would you do that in South Africa and set that structure up with youngsters of that age, known as going to be legacy assets? The answer is yes. So yes, we are setting up the international trust. We had a look at all the other structures, and I'll go through those with you now. And we came back, keep it simple. This is a normal passive discretionary trust with long-term capital appreciation. Keep it clean. We'll just set up the trust on the basis that you can end up setting up so many scenarios. And as either the foreign revenue authorities say, well, now you've got a company, a British company that, a UK registered company that owns property, therefore we're now going to tax it. You're always moving the goalposts. So set up for best practice, best advice. The other options are a trust that then holds a company, and then the assets are held in the underlying company. Your mechanism there again is you capitalize the trust, and again, it's an interest-bearing trust. And then the trust onward loans the money to the company, which then invests accordingly. The taxing for your resident planners. So what is your beneficiary got? He's got an interest on a loan account that's then taxed annually, and it's taxed in terms of the section. Let's assume it is a foreign denominated loan. It's then taxed in terms of your section 31 transfer and pricing rates. On death, the value of that loan account is then dutiable in the individual's estate, but whatever happens with in the trust and or the underlying company from South African for a South African estate. Or you have the reverse of it as such, where the planner subscribes for shares in a non-resident company, which in turn then forms a trust. And then that trust shares are issued. You have maybe, for instance, ordinary shares, A-class ordinary shares held by an offshore, the offshore trustee or director as such, with B-class shares or different class shares issued to your planner. The company then lends the money to the trust, which then invests accordingly. I'm very wary on this structure purely because of, as a company with shareholding, could there be any CFC, controlled foreign company implications? So for me, it's maybe just a personal thing on this structure. For me is not ideal when setting up and doing financial, I want to say vanilla financial planning. For the taxing for the resident planner, that individual then holds shares that then needs to be an attendant dividend yield. You can't be in a position where you're taking your money abroad, and especially when in the old days where it was still a foreign investment allowance, and then you were putting, and individuals were then putting it into companies of which there was no dividend return on it, because the structure was, for as long as there was a loan account owned by the trust, no dividends would be declared. My question always was then, no person would invest, or no sound person would invest into a company that was giving them a zero dividend return. I must be honest, I've always pay something from a tax point of view. You don't have to, you can certainly be effective in your planning, but don't take it to the extent that this would not be a situation that you ordinarily would go into, and therefore taint the entire structure. The big one then on death, that net asset value of those shares is then dutiable. We're actually sitting with a scenario, again, that estate that I told you that I've got the query on for 6 months, coupled with the offshore loan account. We've also got foreign investments. And the gentleman who does the valuations for private companies or for companies in the estates department is really smart and really, when I say on the ball, he's come back and basically said that the shares, because the valuation was done by the offshore trustees, that there was no voting rights, only economic benefit. He adjusted the trustees issued a lower market value. They adjusted the market value down, and our SARS official has come back to say, actually, there's substance in those shares. So we're in the process now at the moment of seeking legal advice or seeking counsel as to valuation. So as I say, this one for me, there might be sound reasons for setting up the company, and then with the underlying trust structure, for me, I just think there's too many what ifs, especially from a valuation perspective, and having seen a real live example now where the value of the shares, and in our instance, the valuation was actually determined in the incorporation documents. It was actually said, this is how we're going to value this company on death. SARS are coming back now and saying, we understand, but as far as we're concerned, it's not we disagree with your valuation method. This is what we've come in as value. And I'm going to add the last bit in the form of, as I say, in my mind, there's 4 options in which you set up the foreign trusts. As I said, the standalone discretionary trust, the trust holding the company, the company forming the trust, and then the other one that's quite controversial. And I sat in a meeting back to the same client with the Swiss francs, in that he's got a foreign pension trust. And a question was asked, similar to the one I've asked you, if we could have multiple structures, or if we didn't have to have multiple structures, would we still have a South African trust and an offshore trust? This instance, do we keep a pension trust, or do we put everything in a pension trust? And I don't know if you're familiar with the pension trusts, but basically in August 2002, there was a binding class ruling that was issued. Basically, the pension trusts were, you moved all your monies into the pension trust, and then because it was a pension trust as such, everything that happened then was exempt, and you didn't have any of your Section 7 attribution rules. And because it was pension, it was then taken out for estate duty purposes. In terms of the binding ruling, SARS basically come back and said, you know what, we'll give you 5 years in which to figure this out. In the meanwhile, we are going to have some limitations, with the biggest limitation for me is whatever's within that trust on death, and the pension trust, whatever's in that pension trust in the form of the capital balance on death is a dutiable estate. So what is the point in actually setting up the pension trust? There is, however, a place in setting it up if it's within the ambit of the planner's balance sheet. So let's say, for instance, and again, I'm using this client with the Swiss franc client. He has got this pension trust because he's a sole proprietor in a business. And the business, when I say sole proprietor, he was a sole proprietor. He's brought in partners now at the moment. There's 3 of them in the business. He's the one sitting at 55 and looking at his exit strategy. And the business never had its own pension fund as such. So the fact that out of 100 million, he's got investable assets of, let's call it 120 million. He's got 20 million in a foreign trust and 100 million in a passive investment discretionary trust. In South Africa, given the amount of years service he would have done, he would have had a pension of let's say, for instance, 20 million. So the fact that we're keeping it within the balance sheet, I'm very comfortable with it because he is going to draw, he's going to need, he's 55, he's looking at exiting in the next 5 years, and he is going to need a pension from somewhere. So foreign pension trusts, they certainly have got their place. The fact that there's the binding ruling, one needs to just be a little bit careful then as to where and how you apply it. But in summary, as such, you don't get the tax deductions anymore. There's no tax donations tax payable when you put the monies into the pension trust. So if you were going to capitalize Inter Vivas investment trust, you'd have donations tax. In this instance, you don't, in the form of your contributions. But your Section 7(1) anti-avoidance rules apply. Your Section 25B distribution, so in other words, when you take funds out of the trust, they don't apply because your anti-avoidance applies. As a beneficiary, you can actually nominate another trust or individuals on the death of the investor. On death before retirement, the amount, the full vested amount being income and capital, is a dutiable amount. And then on the death after retirement, the right to the annuity. So you do the calculation of what the annuity amount would be including capital gains, automatically then triggers dutable estate in the form of your annuity, and it then triggers a CGT event as if you had then sold that portfolio or that investment immediately the day before death. So as I say, it's not the most estate dutiable efficient structure, but it is, if your planner, your client is drawing monies and is going to live at, and in my instance with this guy now at 55, he's going to retire at 60, let's just say, assume he lives to 85, he can preserve the capital within the Inter Vivos trust and then live off this pension trust that may or may not have been dutiable anyhow if he was then taking funds abroad. So don't disregard pension trusts in your planning scenarios. That I want to say. So let me just check. With regards to the structures and setups, I just want to ask, are there any questions with regards to the structures, the fact that you've got your normal vanilla trust, you've got your trust and company, you've got your company and trust, or you've got a pension trust as your options when setting up offshore?
Okay, so there's two questions. One's more, let me do the one that's, I think, more with the topic we're doing now. One is it only a foreign pension trust? Is it not a South African pension trust?
No, it's only foreign.
Okay. And then the other question is, for a simple local discretionary testamentary trust, could you please summarize what documents have to be filed, to which authority, and by when? In scenario, one sole beneficiary, one sole trustee, all are family members. Nothing is done via FIs. Trust holds cash assets and listed shares assets locally.
Okay, so testamentary trust is very different than from Inter Vivos. So, Danny, I didn't catch, what was the filing?
So I don't know if you want to if you maybe want to cover this a bit later. It's quite I think, an in-depth question.
Okay, happy to take it later. But just remember quickly, testamentary trusts are very different. And you'll see in the next page coming up, testamentary trusts can in fact hold direct foreign investments. But let's go through that coming up.
All right, and then there's another one.
I'm just mindful of, yeah?
Okay, what would motivate a company owning a trust structure?
Let's say, for instance, you wanted multiple, so again, the scenario with the client who's got the three, parties or three, they could then literally set up one holding company that then creates three different trusts, and then your family members are beneficiaries of the trusts. So it would be, let's say, for instance, if you've got all family members, I've got one where at the end of the day, it's farmers, and they've got a holding company of which they each put in their monies into the holdco, but each of them have got very different beneficiaries, which we deal with via the trust, and each of them have got very different investment requirements, or risk profiles. So that's when you would do the company trust structure.
Okay.
So then just from a taxation point of view, with SA residents receiving a benefit from offshore trusts, remember income, you've got 25B2A. And I want to touch on the conjure principle with that. And then on the capital gains, you've got para 83 that even though the so in fact, the income and the capital gains basically states, or 25B and 80 basically say that if any income and or capital gains has been received by a South African resident that would ordinarily have been subject to tax in South Africa, if it were not had it ordinarily, if it had ordinarily been taxed, then it will still be taxed in South Africa, regardless of the fact that the distribution happens at a later date. And that's why it's highly important when you're guiding a client, or when you're choosing as to which trust company you have, they understand and they keep proper records as to what is pure capital, which is loans and donations or bequests, what is capital being your capital gains, and what is income. Because coming back to the scenario, if, let's say, for instance, you've utilized, or a beneficiary doesn't have a loan account to the trust and they can't get their capital paid, as soon as there's a distribution that's made to that individual, and there was changes to 25B to A. In that previously, I don't know if you remember, you used to say you had the trust company. The company would then declare a dividend to the trust. Then you would wait 1 year and 1 day, so it fell into the next year, and then you would then distribute that money out, and it would then be distributed as retained income because it lost its principal as a dividend. Now that's changed, and it says it doesn't matter when the conduit principle still applies, but it doesn't matter when that income accrued to the trust. When you distribute it, you need to know whether you're distributing pure capital, whether you're distributing something that arose from capital gains, or you're distributing interest and rent. If it's interest, then it's taxed as foreign interest. If it's rent, it's foreign rental. Capital gain, you've got your normal capital gain, and or it's capital and then it's exempt. So folks, and that comes back to my very first comment in connection, and I always wear my hat on then as accountant to say, trust accounting is very different. It's not SME accounting. You need to understand what is capital, what is a capital gain, and the fact that you've made a capital gain doesn't, and it's taxable. Clients often argue with me and say, no, but that's income. It's not. It's very different. But in a scenario of coming back to para 80, that capital gain is then taxed in your South African resident beneficiary's hands. Then we actually, what else? I just want to see if there's anything else. That was then just dealing with the pension funds. So just in summary then, with regards to trusts, offshore trusts, you need to have a look at how your monies get in, whether you're taking your money in on a foreign currency basis. Foreign currency has got better implications short term, but long term, if the rand devalues substantially, you could end up paying far more estate duty. You could do rand based, you pay higher tax now at the moment, but at least you're pegging the value and you've got certainty. And then, as I say, just look at the jurisdictions, keep it simple. I sometimes think we want to become too smart and save too much taxes, and then we get into structures that we don't necessarily need, or then catch us at a later date, like, for instance, this valuation on shares. Those were structures that were set up when there was, discussions around 7C, and then everything, loans were then converted to preference shares, and then we had change in preference shares. And as I say, I can see that now with this estate. So SARS are smartening up. Worldwide, people are smartening up, and they're querying and they're looking at A, substance over form, B, what was the intention, and everybody wants it back somewhere, as or every revenue authority is looking for money somewhere. So there will be some taxing events somewhere along the line. Looking quickly then at wills, and this is what we've done. So if you recall, we had my slide that we dealt with where we said in order to get the funds out of trust, you kind of had to undo the trust scenario, put the money into the individual's hands. And because we had predominantly the loan account, it was then, well, we've got this asset offshore to a foreign trust and we owe monies here. What are we going to do about it, and how do we deal with it then on death? The first one, and I've only got one client, and I still want to say we'll cry one day when we've got to pay that estate duty. His view was, I want to cut the deeming provisions for my family in form of 7C, and I want to make sure that my the assets are directly held. They're with my trust. They can't be called up at any point in time. So he's got about a 300 million rand loan account that on his death, he's bequeathing to his offshore trust. He doesn't want the spousal rollover relief. Most clients first put it to surviving spouse, and then on the surviving spouse, the money then goes, you're going to pay estate duty, or the estate's going to pay anyhow, so therefore the loan's bequeathed back to the foreign trust on the death of the surviving spouse. This is probably the situation, or not probably, this is the situation where the funds have gone out as capital and you don't have the attendant loan account back to the South African trust. One of them is, can you bequeath those foreign assets? So in a scenario, you've taken your 10 million rand out of your trust, you've applied for the foreign investment allowance, your monies are offshore, your cost benefit didn't warrant setting up the offshore trust, you held the investments in your own name, but now you've got minor children, or you've got youngsters and you don't necessarily want them to have their 10 million. Can you then bequeath those foreign assets to your South African resident Inter Vivos Trust? The answer is no, you can't apply, you can't. And I've seen probably about 7 situations where executives have applied and Reserve Bank or SARS have come back and said no. So to the best of my knowledge, no, a South African resident Inter Vivos Trust cannot retain foreign assets in the form of foreign investments offshore. However, a testamentary trust can. So you apply for the permission. What ends up happening in this instance is, let's say, for instance, you've got a beneficiary, a minor beneficiary, you still apply, and I know minors can't, you've got to be over the age of 18, but in this instance, you apply for your foreign investment allowance on behalf of the testamentary trust, and then that testamentary trust can then accept foreign assets. It is a lengthy process and it can delay the local winding up of the estate, because remember, that foreign asset is a dutiable estate, and also you can't finish winding up until you've got a home for that foreign asset. So normally when I draft the wills, I always put in a clause that says, I'm going to distribute, or I'm going to bequeath my assets to the trustee of an offshore trust or the trustee of the South African trust. However, for if any reason that trustee cannot accept whole or part of those assets, then bequeath to and put in a backup clause. Folks, don't just say, in terms of wills, you're going to make an outright distribution or outright bequest to a trust. Always do. What happens then if I've got a beneficiary that's now gone overseas? You don't then want to be in that position where you put in offshore assets into South African testamentary trust and your beneficiary's gone overseas and somebody's forgotten to update the will. So always put in that stopgap clause that says, if this is how I'm planning it right now, if it changes, I will allow the changes, and this is how I see the changes happening. This next bequest.
Before we carry on, can we just also, the question is, when you dissolve a testamentary trust, death of the beneficiary, what are the tax implications?
Sure, what are the tax? There's usually because then normally what happens is there's a second. So let's say, for instance, you set the testamentary trust up for a child, a minor child, and then that minor child dies. Then you're going to need secondary beneficiaries, the next class of beneficiaries, there's a capital gains tax event on the death of terminating the trust, if that's the instance, and then the monies then go to whoever the next class of beneficiaries are. And when I say the next class of beneficiaries, you normally would do it on the basis of, I set up the testamentary trust for the protection and welfare of Joe Bloggs. On the death of Joe Bloggs, the testamentary trust terminates and I want the money to go to the SPCA, or I want the money to go to my cousin. Then when it goes to the SPCA, funny enough, then, well, there's still a CGT event in both instances. The SPCA then receives the monies as such. The cousin gets also the funds, but there's a CGT event.
Okay.
Does that answer it?
I think so. I'll see if there's any follow-up, I'll mention it.
Okay, great. Sorry, folks. Then the next one here is the bequest of a foreign asset to a foreign bottom drawer trust. And I will be honest, I've actually used it in a number of instances. And the reason I've used it is that similar to a South African or testamentary trust, once that planner has died, you can't really change, you can't change, not really, you can't change the document unless you've put in or you've allowed for changes, but you can't then vary beneficiaries for argument's sake. So I've always been wary of setting up foreign testamentary trusts on the basis that once money goes, or once a suit on a muddy island is created as your trustee, to give flexibility and latitude with regards to, let's say, for instance, a beneficiary immigrating from South Africa and going offshore, rather be certain in this one. So to that extent, you create the bottom drawer trust. It is exactly what it is. It's a dormant trust, sits in the bottom drawer, and on the death of the planner or the surviving spouse, those funds, foreign investments, are then bequeathed to the foreign trust. You know who your trustees are. You've got certainty in connection with your trust deed and a line for amendment. You know your and you understand the jurisdiction and the powers of the trustees. Therefore, put the assets into the trust. It's becoming quite a costly exercise because the trust companies who were setting it up said, okay, for 5 years, we'll give you a good deal as far as rates are concerned. But now the fact that you've got a dormant trust and you've still got to do your AML and you've still got to do your risk assessment and your due diligence, and if you're aware of dealing with any foreign trustees, you know that either they want that information annually or they want the information every 3 years. It's actually becoming a costly exercise. So the company I used to deal with on the basis of these bottom drawer trusts, they're saying we'll do it, but actually because of regulatory requirements and because it's included as part of our risk assessment, not full fees are being charged, but a greater amount of fees are being charged. So it's actually an expensive option. Just look at it carefully then from that point of view. Then these next few slides are where you've got a foreign loan or foreign asset to the foreign trust, but it's a back-to-back loan with a South African trust. So in other words, the 10 million's been taken out. It's been loaned to the beneficiary offshore, who's then applied for the FIA. They've then put the money in a trust. So they're sitting with an asset offshore and a loan account owed to your South African trust. From an estate duty point of view, it's perfect because you've got no estate duty. You've got an asset minus a liability. However, the trustee here in South Africa then says, but hold on, the individual has died. I've got to call up that loan account. And this is the only asset that that beneficiary has. In order to then repay the loan account back, you've got to kind of undo what you've done by taking your funds offshore, because then as a trustee, you've got to you've got to somehow get that payment back or that loan back, because remember, you're accountable to other beneficiaries, not this beneficiary. I know when we've done the planning with individuals, they will say, well, we've got sufficient trust capital, so therefore the day before my death, just distribute the money to my estate. Wearing my hat on as a trustee, I strongly disagree with that concept. On the basis of you're not exercising your discretion. I disagree with the concept. However, given the reason for creating the debt, so in other words, we wouldn't be in this position if the trustees were able to invest directly offshore. I think you need to look at it as trustees, you look at it on a case-to-case basis. And in particular, have a look at whether it's in the benefit of all beneficiaries. But more importantly, there's a planning technique that you can actually put in, and I use this very frequently with regards to situations where I've got foreign loans, especially where it's the 10 millions that have gone to the children once they've attained the age of 18, and we put in these agreements. So essentially what we do, it's a planning technique where the parties enter into an agreement. And who are the parties? It's the trustees of the local trust. It's the debtor, being these beneficiaries that you've loaned the money to, and it's whoever your substitute heirs are. So basically, instead of having that as a trustee, or we'll just distribute capital the day before you die, this is a situation that says, when the individual dies, in terms of that individual's will, they owe money back to the trust. They've got a foreign asset. We will agree to a substitution. We, being the trustees, will agree to a substitution debtor. And then these are the conditions. And the conditions could then be the loan must be substituted at the same terms and conditions. There's one of them that we've got where basically the client has said for 3 years, we want to give the beneficiary some growth in the offshore portfolio as such. So therefore, for a period of 3 years, the local trustees can't call up the loan account. An important one is the trustees' discretionary powers may not be altered by entering into this agreement. So in other words, if, let's say, for instance, the proverbial happens and the trustees, to maintain another beneficiary or for whatever reason, have to call up that debt, they need to be able to recall up. They've got to be able to still exercise their discretionary powers and still have all authority to recall up the loan accounts. They must be allowed to. And then so this for me is an agreement where you get around the situation of having an offshore asset with a local debt, wearing your hat on. And in fact, this is probably more in when I wear my hat on as a trustee. You can't just willy-nilly give out 10 millions with never ever getting those monies back. There's got to be some plan in order to get those monies back, but without undoing it. We have in this instance also had the offshore trust, and I want to say, did I put it in here? Sorry, I haven't got it in here, but we've actually used that the substitution then is the offshore trust, where we've said, offshore trust, you are on the death, our planner is giving you the loan back. So there's a forgiving, or they're not forgiving, they're bequeathing their loan to you as an asset. In return for that, you need to accept the local indebtedness. And two different offshore trustee companies have essentially agreed to that. And it's been crystal clear on the basis that we entering into this transaction because as South Africans, we couldn't remit directly abroad from trust to trust. And as a consequence of exchange control, we precluded from the free flow. This is the mechanism in which we've done it. If we were wearing our hats on as investment advisors, given the political risk and currency risk, or country risk, currency, and political, and the fact that you would want to invest worldwide, this is the mechanism in which you're doing it. You've got some of our money, and our money is the money that you've got is there as a consequence of the loan that you owe us back. So on death, we'll give you the loan, but you take our indebtedness. So as I say, that's an option or a planning vehicle, but do it as an agreement. It's actually a legal agreement. We get an attorney to draft it. And as I say, in the agreement, the preamble to it is, it's got nothing to do with trying to limit creditors. It's got nothing to do with anything other than it's as a consequence, or it's arisen as a consequence of restricted South African exchange control. That then quickly is how do we deal with South African wills, with foreign trusts, foreign assets, South African liabilities. So then the big one is, so how many wills do I need? In most jurisdictions, our South African letters of executorship are not recognized. Most financial institutions, and I had that with Royal Bank of Scotland, in order to change a bank account from Mr. to Mrs., they wanted court-sealed documents, and those court-sealed documents took over 8 months. And in that time, that money was sitting there and we could do absolutely nothing about it. So to that extent, my advice usually is, if there are worldwide assets, do consider a worldwide will, nominating essentially an offshore administrator. You also don't need a will per country. So I once consulted a client who had property in the UK, had property in Portugal, and then had an international share portfolio that was actually administered, believe it or not, in the States. And he had 4 wills: a South African will, a US will, a UK will, and a Portuguese will. The US one I would agree with, because the US, when it comes to dealing with anything from a probate point of view or changes, I might always consider US, definitely without a doubt, US local advice, but certainly consider US wills, because remember, in the US you've got state as well as federal taxes. So just because you're providing and you've got advice in connection with, let's say, for instance, California, and then you've got advice that this is how you're going to structure it, and now you've got a client who's Texas-based, not even the same country, different rules apply. So US, as soon as there's US, be very, very careful on that one. But my view is, if you've got a movable property, always get an offshore will, purely because it just makes probate in the form of the administration a hell of a lot easier, especially if you're renting the property, or you decide you want to sell the property, or you've got forced heirship, like for instance in Spain, France, or Francophone countries, you've got your forced heirship. Put in a will. Do you need a will per property? So if you've got a property in Portugal and a property in UK, do you need one per country? No, one worldwide will, where your administrators have got access. You only need one will as such. Ease of administration. Then often clients say, yeah, but let's do the offshore will, because then I don't have to disclose anything in my South African tax return. Wrong. Those foreign assets, unless they came from pre-immigration, and its immigration is in IM coming into South Africa, or it was inheritance of non-residents' money. If you've transferred funds in terms of your foreign investment allowance, it might be held in a bank account in the UK, but it's a South African asset and it's estate dutiable. So just in summary, folks, sure, I've gone quite quickly I'll answer some questions now, but I just want to say in summary, know your client and at least a generation's. So, Danny, just coming up, is there anything in connection with the wills?
Yeah, so about when a testamentary, or what happens when a sole trustee, an individual of a testamentary trust dies?
Then you usually, so if you, again, what I would do, and as a trustee issue, and I would do that with the testamentary trust as well, hopefully your will has given power of assumption. So power of assumption means that when a sole trustee of a testamentary trust dies, that person should literally have said, in the event of my death, I nominate my business partner, I nominate so-and-so. You actually need a continuity plan. So the first thing you need to do is check in your will whether there's power of assumption. Otherwise, it then basically is up to the master to appoint a trustee, a replacement trustee.
All right, then in terms of wills, is it not that each country has its own laws and the will has to be set up according to that country's regulations?
So it's got its own rules as far as situs tax, etc. is concerned. But the answer is no on the basis of, so I'll give you an example. We usually use, and it's just the guy's names. I think most of you would know Oliver Phipps. I've just forgotten the company name. So they the administrator. And then if you've got a property in Portugal, they've got, like you would do if you were using executive in South Africa, and they had, let's say, for instance, monies in overseas. If you were using, I'm confusing. If you were, let's say, for instance, using Hughes would be a executive that's got offshore entities. If you've got somebody who you can give a direction to and say, do this offshore, likewise, you would have still a UK based or a will appointing a UK probate administrator, but that probate administrator's got the capacity to literally then contract directly with Portugal, with Spain. So yes, they've got different rules as far as estate duty is concerned, and they might have different rules as far as forced heirship, but then by putting in a will, you negate forced heirship. If you haven't got if your will doesn't specifically deal with the property that you own in Spain, and how you wanted to distribute, then yes, you are right. Forced heirship then would and could automatically apply. So the answer is each country has its own rules and regulations. And I'm going to give an example if this is what the person was alluding to. Let's say, for instance, you're drafting a Portuguese will that's dealing with worldwide assets, but your probate administrator, it's essentially, for all intents purposes, a will that's drafted in Portugal. Then, in order to have it witnessed, it's got to be translated into Portuguese, and you've got to actually go to if you're executing in South Africa, you've got to go to the Portuguese Consulate General and have it witnessed there. So it depends where you executing it as such. So remember your South African wills, you say, I, Joe Bloggs, currently residing at number 7 Appleboom Santon or Joburg. The reason that you put that in is so that you know where your reporting is to happen. Because remember, your reporting, and also from a probate point of view, like you've got to advertise for creditors, and likewise, you've got to advertise your L&D account, they've got to do it offshore. So you need to know, is it a UK advertising because you've drafted essentially in the UK, or is it a Portuguese executed will? Then yes, then very definitely there's Portuguese requirements. But it doesn't mean you can't have one worldwide will that your UK probate officer can then still deal with your Portuguese assets.
Well,
but you would go to somebody like, for instance, an Oliver. When we drafted he was the one who then came back and said, we don't need a UK will because this client only had the Portuguese property. He then got hold of a Portuguese advisor who then said, hold on, we'll draft it, we'll translate it into Portuguese, but you've got to go to the Consulate General. I, for instance, couldn't, as a Commissioner of O's in South Africa, I couldn't commission it or notarize it. You couldn't use a normal notary. It had to be notarized essentially on Portuguese soil, which was in the consulate.
Okay. All right. And then it's that big question about the summary. So let me read it to you again. For a simple local discretionary testamentary trust, could you please summarize what documents have to be filed, to which authority, and by when? Scenario: one sole beneficiary, one sole trustee, all are family members. Nothing is done via FIs. Trust holds cash assets and listed shares assets locally.
Okay, so technically in terms of the UBO, you would still have to file the UBO at the master's office. I want to say, please send me a heads up in connection with that. But from a FIC point of view, there's no testamentary trusts are excluded. Sorry. Your testamentary trusts are specifically excluded from your UBO, from your masters. In fact, you don't have to. The only thing you've got to do is your SARS e-filing. You don't have to submit the UBO. Testamentary trusts are specifically excluded.
Okay, hopefully that answers it.
And it's a sole benefit. The sole beneficiary is usually a minor child. Your sole trustee then is also a family member. There's no FIA, so it's basically, it would be a local cash and a local share portfolio. All you've got to do. So from a taxing point of view, it's an interesting one. It depends on what if it's discretionary. If you haven't distributed, you being a trustee, hasn't distributed all that income to the beneficiary, then you've got two taxpayers. You've got your testamentary trust as a taxpayer, and then you've got the beneficiary as a taxpayer. So let's say, for instance, the trust earned R1,000 and they paid only 500 in the form of school fees, which was distributed to the beneficiary as interest. Then you've got to register your beneficiary, the minor child, who will then disclose 500 Rand interest in the tax return, and then the other 500 Rand that stays within the testamentary trust must then be taxed in the hands of the trust. From a taxing point of view, if it's a minor it's a child under the age of, it's changed and it's now, I think, 21. So remember, age of majority is 18, but a testamentary trust is created for a minor under the age of 21. You then still get the individual tax rates. If it's, let's say, for instance, set up for somebody over 21, it's then retained within the trust, then it's taxed at trust rates, not beneficiary rates. If it's vested, everything gets taxed in the beneficiary's hands. So I think, Danny, the point on this was local discretionary testamentary trust. Discretionary, you have a look and see what was distributed, that's taxed in the beneficiary. What remains in the trust, it's then taxed. Do you then tax it as a trust A or as a trust B? I think A is the one where it's a minor child under the age of, a beneficiary under the age of 21. Otherwise, it's then taxed at tax rates, flat rate of 45%, no rebates.
All right. And then the one comment on this was the IT3T.
Oh, yeah. Can I then turn off this summary sheet and then maybe go on and have a look? Just quickly have a look at your client. I've put in here, at some point, make a decision and go with it. You know what? I've been in so many scenarios where clients have said, let me think about it, all because of the what ifs. And then you never make a decision and you never go around with it. So, yeah, it's make a decision. Offshore, it's I do want to say it's not a minefield, but it's not as, there's a lot of questions one needs to answer. Do you still need to do it? And the answer is yes. Coming back to the IT3, it says answer live. What was the question, the open one, Danny? It just said IT3T.
So it was, I think it was a follow-up on that with a single discretionary.
Okay.
Yeah, it was just this, he was emphasizing further on his question.
Okay, all right. With regards to the IT3Ts, I do want to, and maybe this is a punting on the basis of CPD, I actually think it's probably by about, hopefully December, we have some sort of clarity as to what's required. But by January, as tax practitioners and accountants and trustees, we're going to need to know what is actually going on with those IT3Ts, whether it's, I don't know if it's something that you, Danny and Stan, would have a look at in the form of having group or practice discussions, but I want to say that's that's going to be a challenging one. If you think February provisional deadline is tight, couple provisional deadline now with having to have information, accurate information to pre-populate tax returns by 31st of May, where your source information hasn't been issued yet because your trust companies usually only do that come April, May. As accountants and tax practitioners, our time's fine.
Yeah, I don't know if there's any other questions now. But yeah, we'll make things going forward. I don't know, does anyone else have any questions? I think then I'll hand, I don't know if Stan's still around here, but I want to thank everyone for joining. Stan coming on to do the wrap up.
Well, thanks very much. Obviously, judging by the number of questions, it's still, there's a lot to be answered. And if you do have questions, please send them to Danny and he'll forward them to Cheryl. And I'm sure, Cheryl, you'll be happy to spend the rest of your days answering these questions. But thank you. It's very thorough. You've done I mean, it's an amazing amount of work and preparation that went into this presentation. And thank you very much. Everybody, your certificates will be on their way to you. And thanks for attending. Thank you, Cheryl, for doing this. We really appreciate it. And everybody keep well, and I hope the Bokke win on the weekend.
Thank you again, Stan. Yeah, so I think, Cheryl, you see then that last question that people are asking for your email. It is in the notes that I saw you sent out. It's in the last page of the notes. I'm
not going to go back, but it is on the last one.
Yeah.
And thank you all. I'm really sorry for starting late. But I think we covered everything.
Yeah, I think so.
And more. So thanks again, really. And as I said, if you do have questions and you don't have Cheryl's email, then please send to Danny, and Danny will forward them on to you.
All right.
Magic.
Thanks, and we'll see you. Thank you. We'll see you all next month for Jackie for the final year-end update.
Yes.
Perfect.
Cheers, everyone. Thank you.
All right. Thanks, then.